Welcome to the Dividend Talk podcast, episode number 4, quarter 2 portfolio review. Hey guys, welcome back to another episode of the Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm here with European VGI. This is a podcast where we discuss our passion and knowledge for investing in personal finance. Coming up in today's episode, we'll have a brief look at the news. We're going to review our portfolios for the last quarter, as well as taking some questions from our listeners. As always, we appreciate all our listeners, and if you're new, please hit the like and subscribe button on YouTube and Spotify. Let's get straight into it. CMF here from the sunny southeast of the Republic of Ireland. Hope the weather is shining where you guys are. It's been a super fast week for me. I don't know about you guys. European VGI, how has your week been?
My week was actually pretty good. I spent a lot of time at work, really productive work. So that feels also good after a while again, after having not so many productive weeks, at least from a feeling point of view. But I also had a pretty productive week on the stock exchange because there was a lot going on. I purchased some stocks again, so I added a little bit to AT&T, and I added a little bit to my position in Danone. So I had a pretty good week there. And my news from the week is might be a little bit surprising for a dividend growth investor, but it was the gold price. The gold price is nearing its all-time high. So it had its all-time high back in, I believe, when was it? September 2011. It was then around almost $1,900. Today, fast forward, almost 9 years later, it's on $1,800. It's closing up again to this level. And we came just from a low in November 2016 when it was around $1,050. So, and for me, this is very interesting that the gold price is so high, stock exchanges are so high, and usually you would expect it a little bit keeping it in balance. Yeah, when stock markets go high, then the gold prices would be lower. But in this case, the market is so awkward. And I always look at gold as an indicator, kind of as a fear index. So it just tells me there's something pretty wrong currently in the market. And I don't know what to do with it really. But it really grabbed my attention again this week, because sometimes you see these news items on the background and it makes me really think. So but what's your thought on gold?
Yeah, it's not surprising that it's up so high in my opinion. You've got the Fed printing money like there's no tomorrow. It's just been printed trillions and trillions of dollars, and where does it stop? I think we touched on it last week in last week's episode that it just seems out of balance at the moment. As you said, the stock market is so high. It's been propped up. We've got a pandemic. Gold is at an all-time high, and something's not adding up in the market. I think it's going to drop at some point. I don't know if it will. It could just keep going up. It could be like Tesla. They just seem to go up. But I'm with you on this. It's for me, it is an indication, and it's an indication that something is, as you said, not right in the market. And I believe we're in for a correction sometime soon. Is it too late to get involved in gold? Probably. The time to get into it when it was 2016 at 1,000. So it's not something that I'm invested in or something I will look to invest in, but it's certainly an indication that it's probably a good time to sit back and wait and see what the market's going to do.
Yeah, I agree with you. At least my philosophy has always been dividend growth investing in combination with value investing to protect the principles. So I think that's something that's been doing me well so far. So I'll keep doing that. And just dollar cost averaging every month at least allows me to, I would say it, not to invest large sums of money exactly at the wrong time or something like that. Yeah. Okay. So Imef, it was a bit quiet on your end this week, but what was your news then?
For me, my news was that it rained all week while I was camping. That was about it. I was away, as I said last week, I was away camping all week. So I had literally limited access to phones. I didn't bring a laptop. I just wanted to chill out, spend some time with the family. And as I said, it rained. So rain and technology wouldn't have worked too well anyway. But look, we had fun, climbed some mountains, swam in some lakes, and I'm back to reality now. So I'll be back next week with some proper news.
And did it make you think about your journey on towards financial freedom?
It did. It for me. I had a chat with my wife on the way home, and it actually made me want financial independence a lot more. I mean, I enjoyed the time I could get up whatever time I wanted, no time to go to bed. I didn't have an agenda. I just switched off more completely and just got to spend that time with my family. It's what I want. It's the reason why I do this. So I really want to accelerate that. And we had a great chat of how do we get there quicker? Do we pay off our mortgage quicker? Do we invest more? And we're bouncing around loads and loads of ideas. So the good thing is she's on the same wavelength. So we should start ramping up our investments hopefully from now on.
Well, for me, those are typically the best conversations. Nice.
It's rare because she's really not into finance, but when we do talk about it, she gets really hyped up and she's like, "Let's go, let's do this." So it kind of spurs me on a little bit as well.
Cool.
So we'll just move on to our main topic. So we're going to have a look at our Q2 portfolios. So I'm quite interested. You've probably done a little bit more work on this than I have, but I'm interested to see how you perform so far.
Well, Q2 was probably one of the most awkward quarters that I had in several years with this whole pandemic. So that's why this is also so interesting. So if you look at how my portfolio performed, and I will also pull some data up for the people that are listening via YouTube so that they can see it right now. So what is probably the most important to know is that in Q2 I've been spending more than I usually spend. So I spent actually more than I usually save. I had one time written a post also on my blog about it, that I've got a bit of a war chest saved over time, exactly for these kinds of times when stock markets are down. So I've been spending quite a bit more than I would usually do. Instead of buying once a month, I've been buying at least once in 2 weeks at the moment. So I doubled my investments, which also reflects therefore in my portfolio performance. So I can briefly list which companies I purchased. So on the 3rd of April, I added some shares of Munich RE, the German insurance company. On the 8th of April, I purchased some shares of Danone. Then on 29th of April, I purchased some shares of Unilever. 4th of May, BASF. 6th of May, PepsiCo. 6th of May, 3M. 6th of May, Chubb. And that was actually after selling my Disney shares at the time. Then I also bought on 15th of May, I initiated a position in Realty Income. On the 26th of May, I initiated a new position in Red Electrica. And on the 29th of June, I initiated a position in AT&T. And on the 22nd of June, I dripped my Royal Dutch Shell shares. So all of this gave me also quite a bit of new dividend again, new dividend income or forward dividend income. The sad news is that it's largely compensating the dividend cut from Shell back in March. So it's like the net effect, if you would look in over the first half year instead of only Q2, means that I at least covered the loss of dividend income from Shell, and I covered it quite well, right? It's not like 1-on-1. I think I'm 30% higher than what I lost from Shell. And I guess that's also what's so nice about this, that I'm still in the accumulation phase. So now it actually doesn't hurt so much. It's more like I've got less to reinvest. I'm not living off from it yet. Also, my diversification means that it doesn't wipe out everything. So I think I bought quite some cash flow over the last quarter, and as you can see, these are all quite defensive companies from that point of view. There's no tech in there or any high growth company in that regards. What means also that my projected annual dividend income is now the level, again, around, let's say, 25% of what I need to be financially free, which is for me really aligned with my goals for this year. On the stocks that I purchased in Q2, I actually also made already 12% unrealized gain for the people that will be interested in the capital gains. This might sound not so much when you think about how the stock market rebounded from the lows back in March. But I would like to mention that most of my stocks I bought around the beginning of May and later in May. So it's just like in 5-6 weeks, which for me is quite good. It doesn't actually matter in the end because I'm not looking really at capital gains. Now, when I then look at dividend income, I did actually in the year-over-year growth, so including the dividend cut from Shell, my dividend income for Q2, so after tax, grew with 29%. And my April month was a little bit lower than last year. That had to do with few stocks paying the dividends early in May or shifting it to June. Yeah, so some people, some stocks have delayed their shareholder meeting and therefore they have paid it later. And this is also visible in June. So in June, my dividend income grew like, I don't know exactly, but probably like 60-70% compared to last year. But May was a really good month for me, and May is typically the biggest month for me in the year when it comes to dividend income due to the amount of, how is it, European companies paying the dividends then. And this was really visible, and it's just nice to see. And when I see this money that it is now, and as you know, I'm not too transparent about the exact value of my portfolio because of privacy reasons. But this amount of money now already, 25%, let's say, covering expenses, is something that makes me already really proud on my path to financial freedom. And what they say is like the first 10 to 20% is the hardest. I can see this because now with the dividend reinvestment, it's much more easier to grow dividend income than it was when you are, buying your first shares from your whole portfolio.
25% is an awesome number to achieve. Just to give our listeners a little bit of perspective, how long did it take to achieve that level?
6 years.
6 years.
Yeah, 5.5 years. But I can tell you that I was probably at 10-15% 1.5 years ago. So it just shows really that the compounding effect is really, really kicking in now. And I wouldn't be surprised if I'm in 8 to 10 years from now on 100%, right? If I follow my model and the calculations. So it just shows how important the last years are when it comes to the compounding effect.
15 years to financial freedom sounds pretty sweet to me.
Yeah, and that's actually the number, right? If you do all these calculations, and I've got a template for it also on my website, people can make a copy and calculate themselves. But if you think about the 6-7% annual growth plus, let's say, 3% yield on cost for every investment you make, it does indeed take around 15 years at a 50% savings rate. So yeah, I think that's, for me, 15 years is typically the golden number. If you're able to save 50% of your income, you should be able to achieve financial freedom around that. So, yeah.
And looking forward into Q3, is your spending going to slow down? As you said, you've spent quite a bit. You have a war chest aside, but do you, from what we talked about earlier, do you imagine you'll slow down and only invest once per month or once
Oh, I
every
don't
2 months
see a
going forward?
reason. No, I don't see a reason for it now because if I look at several stocks that I also bought in the last quarter, I find enough value place at the moment in the market that I don't see really a need to slow down, but I will not speed up either. So if something like in March would happen again, I will probably double again my investments. I will probably keep it pretty much the same, unless besides tech stocks, now everything starts to grow really rapidly. Then I will probably back off a little bit again and take a slower pace. But for now, I can still see myself investing a bit more. For instance, in Red Electrica, if it dips below 16, I will probably buy some again, and I wouldn't wait. I wouldn't wait till my salary to come in again to purchase some more. Yeah. Maybe last but not least, my portfolio from a from a total, let's say, value point of view, grew compared to last quarter with around 17%. And this is, of course, mostly due to new contributions to the portfolio. But I think if I would take those off, probably it would have grown with 4 or 5%. So, which is not bad, I think.
Yeah, it's very good.
No. Hey, but that was a little bit a summary from me. How did your Q2 go when it comes to your portfolio?
So overall, my portfolio, well, I kind of looked at it a little bit differently to what you do. So I use performance attribution to calculate how I'm doing. So I'm going back as far as January. So it's actually 6 months over the last 6 months. And what I have is benchmarks for each of the sectors. I'm using ETFs. It was actually the Sunday investor on Twitter who sent me a spreadsheet before on how to actually calculate this. And I've automated a little bit and put it into G sheets and included my dividends and how they are reinvested into my portfolio. But this year, I'm currently down 5% over the year against the benchmarks, which are down 3.7%. So I'm underperforming at the moment. And when I look at why, the big reason why is with real estate or REITs. I'm invested heavily in Tanger at the start of the year, and they dropped massively. I think they dropped 60-70% in price, and now they've cut the dividend, and it's been a real disaster and a real lesson for me. In for that, it was the high yield that attracted me, and I probably convinced myself to buy them based on the yield and wanted them to fit into my strategy. And while looking back, it wasn't such a good play.
Yeah.
And I did invest more than what I normally would in them at the time, and it's come back. So my return on real estate and REITs is minus 44.57%, which is making up a massive part of my losses. Yeah. If I was to take that out and that never happened, I would be outperforming the market at the moment by about 3%. So it's a learning curve for me, but it's really good to be able to look back and see how I'm performing and have a benchmark to compare it against. It's something that I've only recently done. As I said, it was introduced to me, I think, in February or March, and I've been tweaking it ever since. Before that, I was kind of just investing and never really looking at numbers, just looking at my dividends coming in and thinking everything is okay. But I suppose I'm at an earlier stage than you are in this investing journey, and it's quite, in its infancy. So my dividend growth is going to be much bigger than what yours is. 20-30% for you is massive, whereas between the same period this year and 2019, I've increased it by 3 times the amount. So it's like 300%, which is massive. But that will start slowing down now that I have more invested. And my strategy is just to invest the same amount every month. In March, I did put in a little bit more. When the dip came, I did put in a little bit more because, like you, I have got a war chest aside, and when it dips, I'm ready to put extra money in. But other than if it doesn't dip, I just put in the same amount every month.
Yeah. That's very interesting what you said, because what kept my portfolio mainly down was my allocation to the energy sector, the oil and gas. So I own some Chevron, ExxonMobil, BHP, Shell, and of course I'm quite down on those when I reviewed my portfolio. But I've got also Apple, I've got also Microsoft, I've got also Google, and those really lifted it up again. So it kept it kind of in balance.
It's good to learn the lesson. I'm sure there's a lot of new investors out there, and a lot of investors that will make the same mistake I did in the first couple of years, and they'll see that high yield and they'll see that big dividend payout, and they will try and make that fit their strategy, and they'll probably over allocate what they should. If I had stuck to my strategy and spent my usual amount, I won't be down 44%. It might be down 30, 20%. And it's a big difference. Yeah. But I did see that huge dividend payout, and they did pay me out twice, and it made a massive difference. But in the end, I've ended up selling them now because they've suspended their dividend, and they don't match my thesis. So huge lesson, and I think it's good. I think it's good for investors to see you're not always going to be up. You're not always going to beat the market. You're going to make mistakes, but it's okay once you learn from them, and once you know in future, don't do that again.
Cool. So anything else from your side around the Q2 portfolio performance?
Oh, for me, as I said, the dividend growth has been strong. It's 3x the amount. I'm projecting, based on last year, I'm going into 4 figures in dividend income for the year. That's the highest I'll ever be. I'm consistently hitting 3 figures in dividend income a month. Cool. Compare that to this time last year, it was 10, 20 a month was the highest. So it's growing. I can see it's growing. I'm 3 years into it now. Maybe when I'm where you are, I'll be sitting here with 25% of my cash flow income. I don't know what it is at the moment. I haven't actually calculated that figure out. I'm just trying to focus on growing it as much as I can over the next few years, and see where it gets to.
Yeah, cool.
So I think this leads nicely into our next question, which comes from one of our listeners. It was from Twitter, from Letters Compound. And he asked, does dividend investing from early on limit the growth rate of a portfolio? Is it not better to first invest in growth stocks and then change to dividend stocks when you really need income?
So this question is so spot on with how I often feel. Yeah, if I look at my Microsoft, or if I just look at friends and colleagues that I have that went full into Tesla or Shopify, they went from a 4-digit number investment suddenly to a 5-digit value. I'm jealous on such performance, right? Seeing a stock. I mean, I was looking at Tesla at $160, like not even that long ago, and now 1,300. It's a 10-bagger. So I thought about that answer a little bit, and first of all, I totally understand where it comes from, because it's the fear of missing out. In my case, and I don't know if the same is for Letters Compound. So I'm curious to hear that from him. What I can tell you is that if I would be in my early 20s, probably I would go more for growth investing, because probably I might also understand some of those stocks better than I do today. I'm now almost 40. I have, let's say, I don't have the time to gamble so much now with my money. And why do I say gambling? Because I find it really hard to understand and value a growth stock. I find it really hard. So for me, it's more important to invest for cash flow and to protect principal. And but if I would be in my early 20s, if I would lose my whole investment portfolio, I know I could recover from that again. Today, it would be so hard and painful for me to recover from losing my portfolio. So I understand where it comes from. Yeah, let's say you can turn now with those tech stocks $1,000 in 2-3 years in $10,000, for instance, because that's what we're seeing out there now, and then use those 10,000 to invest in dividends. Yeah, that will be a perfect world. I just don't know when to sell a growth stock, because I thought that Tesla at 160 was overvalued. So now with 1,300, I don't know anymore, right? But I'm curious to how you think about it.
Yeah, I know we spoke briefly about this before we went on air, and I felt it's going to be a little bit of a biased view, because we're both dividend growth investors. That's what we know. That's what we do. I'd love to hear from an actual growth investor to get their perspective on it. But I'm like you. I'm just not good at valuing or knowing when to sell or when to buy growth stocks. So for me, it is a gamble. When do you buy and when do you sell? For example, if I was 19 or 20 right now, how do I get into growth stocks? Technology is really taking off, but is there much growth in that? 12 months ago, you would have looked at it and maybe said it can't grow, but it has. Do we still do it now? Do I get in? I mean, it is just a gamble for me because I don't understand it, or I'm not that much good at it. I prefer dividend income. I prefer to know what's coming in. I can see the growth. I can see the cash coming into my account. So for me, it's not about age. I know growth stocks have the potential to earn wealth quicker, but I have a plan in place. I'm happy enough reaching that in 10, 15 years. With growth stocks, I don't know if I could have that plan in place because you don't know how fast they're going to grow, how they're going
Yeah.
to grow, when they're going to grow, and when do you sell, or when do you even switch over to that point? What is that point?
Yeah.
So when you start at 20, when do you say, okay, now is the time to change to dividend growth?
Yeah.
Say you say I'm going to change it on 40,
Yeah.
and then those growth stocks were in the middle of a recession and they're after dipping 30, 40, 50%. Do you sell at that point and switch? Or do you keep going, waiting for them to come back and
Yeah.
then switch?
So there are two thoughts that come to my mind. The first one, I mean, I'm fully with you with you need to have a plan. So for me, the plan is the first important. I'm with you. Sticking to the plan is probably even more important. How tempting it can be when you see other stocks growing so hard. Second about this, I really like Jim Cramer and his book Get Rich Carefully, and he has some rules there. So, for instance, and I don't remember it correctly, but for instance, if you invest 100 and it goes to 200, take your money out again, take the 100 out again, and let the other 100 ride. Yes, and I think that's probably when it comes to growth investing is a good thing to do, because then you can allocate that 100 again to another stock. But you always take your principal out again, and you, how we say it? He calls it always, you play with the house's money. And that's a really nice philosophy, which I will probably apply if I would be purely for growth investing.
Yeah, it's great. It's a great theory. It's great in theory, that philosophy. But imagine you're in that mindset and it's growing and you take out that 100. In the back of your mind, you will have that nagging thought saying, I should have left that in. It's now gone to 300. And I think it's hard.
Yeah,
I think the psychology for a growth investor is probably a little bit harder than a dividend growth investor.
yeah,
Purely, not so much greed, but when is that point when you get out?
yeah,
For a dividend growth investor, it's simple. They sell it, they cut
yeah,
the dividend, I get rid of the company.
yeah,
For a growth company, I don't see it as being clear cut. But as I said, I'm a dividend growth investor, so I'm a little bit biased. And
yeah.
I'd love in the next few weeks to get someone maybe with a growth mindset and to challenge us and to
Yeah,
really
we should get someone on the show.
maybe change our
Yeah,
point of view and push that
yeah,
a little bit more. But it's a great question, and it's something that I'm sure will come up again and again. So thanks
yeah.
very much. Let us compound. The next question was from Beres Wolf, and
Hmm.
it is, what company will hit 2 trillion first?
Yeah, that's a really easy to answer, Wolf. That's Saudi Aramco. Saudi Aramco currently has a market cap of 7.3 trillion in Saudi riyal, which equates to approximately 1.95 trillion in US dollars. It was actually already above 2 trillion US dollars earlier on in the year. So literally, if it goes like a little bit up on Monday, then it will hit 2 trillion, and that would be rather quick, I would say. But maybe I should probably answer the question of how is how he's intending to ask it. So I just checked a little bit, right? We have Apple at 1.5 trillion, Microsoft at 1.5 trillion, Amazon at 1.4 trillion, and Google at what is it? 980 billion or something like this. These are the numbers per 1 July. So what do you think, EMF? Which one?
From those companies, it has to be Amazon, doesn't it?
Yeah, I thought the same. Amazon. I think Amazon is the company that for me has kind of unlimited growth compared to Apple and Microsoft. With Apple and Microsoft, at least with Apple, I still have a feeling that people look at valuation, and I guess with Microsoft as well, because it is a little bit still more stable business. But with Amazon, they're all over the place. You could always find a thesis why you could double the money on Amazon, I guess.
Yeah, I'd agree. Amazon, they just seem to grow and grow and taking over more and more markets. So there's
Yeah,
unlimited room, unlimited
yeah.
potential there to grow.
Good. I need a crystal ball.
Let
We'll
me
ask
know
that
if you
for
get
my
one.
wife. Yeah, exactly.
And then the last question we had was from the Sunday Investor, and he asked, "Are we in a technology stock bubble, or are these becoming the new defensive stocks investors will turn to during a recession?" What are your thoughts on that one?
Well, first of all, I think that somehow the underlying thinking has also driven let us compounds question and Burswolf's question somehow. So I know I'm speculating here. I would love to hear from them, but it's again a little bit in the growth in the tech area, right? Yes, I think we are in a bubble, simply said. But I think that's already for 2-3 years. I think these valuations make no sense to me, and I don't think that the companies cannot keep up with their earnings for most of them. Some of them they actually make a profit and actually earn money. Um, so, for instance, I'm really a big fan of Shopify and what they do. But when I then look at their valuation and what kind of growth they need, I think we are in a bubble. Yeah, I wouldn't be surprised if we would in 10 years from now say it was a lost decade, like we saw in the from early on 2000 when Microsoft was at all-time high, and it took them also more than a decade to recover the from the stock price again. So yeah, I think
Yeah,
so.
I kind of agree. The last time I recall that we had such a narrow breadth in the S&P 500 was around the tech stock bubble in the 2000s. It was under 20%, and it's just under 20% again. So those tech stocks are really propping up that whole market. And you look at the likes of Apple, or you look at Facebook, the revenue is coming from ads. And if we have some sort of a recession, you would imagine the ad revenue will drop. Companies are not earning enough; they're not going to be spending enough. The same with Apple products and much of the tech sector. But we do have the likes of Amazon, and we have the likes of Zoom that will come along that people will need. I'm really on the fence on this one. I feel like we are in a bubble, but I can see so much room for growth and potential, and we are kind of digitalizing ourselves. We're becoming more digital. Every single thing is coming online. People are becoming more used to it. Younger generations are coming up, growing up with this. So maybe the tech stocks will be the new defensive plays. Maybe they'll be the stocks that people will go to. We don't know what companies are around the corner. Technology is so fast. Like, who could have predicted Zoom, for example, with the growth they had recently? I don't think anybody.
Yeah. So the defensive stocks, if I think about what makes a defensive stock, right, and then I start thinking about consumer staples again. It's not easy to copy Danone. Yeah, it's not easy to copy a Unilever. It's not easy to copy Procter and Gamble. Why is it not easy? Because it's so driven by supply chain and everything. Yeah, and also by product marketing. You build up a relationship with your consumers, but it's so easy to copy Zoom. And we switched also so easy to Zoom, so we can just so easy switch away again from Zoom. I think there are enough examples about Facebook and their predecessors that don't exist anymore, almost, right? So I see the youth moving more to Instagram. I guess I, as a person, grow up with Facebook, let's say, as his first social media platform. But it's so easy to switch technology and platforms. So if you think about it becoming a defensive stock, or let's say like how I know defensive, then I think Microsoft is already defensive by itself. It's just way higher value than it was like 3-4 years ago. But no, then my answer will be no. I don't think there will be new defensive stocks because just the technology is much more easier to be copied, and I don't see the supply chain effects in many of those stocks compared to what the consumer staples have. even for Shopify, I think it can be quite easily replaced. Think about Wirecard. It's gone now effectively. There are 2-3 others that can pick this market up just as easily.
Yeah, no, that's a good point. But it'll be interesting to see how investors and retail investors will adapt and change. And I do think tech stocks will play a big part. As you said, it can be easily copied, but I think branding has a lot, and brands stick in consumers'
Yeah.
minds. And Google, Apple, I think they epitomize that, for example.
Yeah.
So it'll be a shift. Maybe in a dividend growth portfolio, they might not be defensive, but they certainly, from a growth perspective,
Oh yeah.
they'll be the go-to stocks.
When
So,
I think from an economy perspective, I think this is just the new world, the new what we live in, and it's there to stay. Yeah. So I'm fully with that kind of thinking, definitely. Yeah.
good stuff. Thanks for the questions, everyone. We do appreciate it. And anyone else have any questions, feel free to ask us on Twitter, and we'll get to them next week. So on to my favorite part of the week, and that is to ask you what your stock pick for this week will be.
Well, surprise, it's Danone. I just wrote a post about it. I will put it also in the description of the YouTube video and such. Yeah, for me it's Danone. I did an analysis again on it, and what I just like about this stock is just the products that they have. So I mentioned maybe before here also in the podcast or on my blog that I turned into vegan diet half a year ago. So I got really familiar now with their products. And I can say they are really a market leader in this space. The analysis confirmed that again. It is a boring company from that point of view. Don't expect rapid growth, but it has a 3.5% yield at the moment if you buy it now, something like that. I see it growing with an average of 6 to 7% in the upcoming several years ago. I think the health conscious consumer is their catalyst. And I think more and more people, at least I see it around me, are becoming more and more health conscious. I don't know if it's my age that people start thinking like, oh, I need to watch my weight now. But I have also a feeling that it's really a lot to do with like everywhere these vegetarian restaurants are opening up here. And I know this is Poland. It's not representative for the rest of the world. But if I see the data and also read through Danone's reports, it's clear to me. So for me, it's Danone. I will not call out too many numbers now. People can read it in my post. But what I love is that the management is really prudent. They're not spending money in financial engineering or self-enrichment. I really have a feeling that they have a good balance between shareholders and stakeholders, and they actually just confirmed that again not that long ago, that they will focus really more on the stakeholder model than a shareholder model. I like that. Unilever has done the same. I think that's the purest way of a sustainable business that you can build. And it means also that if all stakeholders are satisfied, it means also shareholders should be satisfied. So for me, that's the perfect goal for a company. What is your stock pick from the week?
So given this week's theme was tech stocks, I'm going to stick in that sector. And this week I'm going for Cisco Systems. I suppose I haven't given as much thought this week as I have previous weeks because I've been away, but they are on my watch list quite a while. They've got a current yield, I think, of about 3.1% dividend growth for just 9 years. What I do like about them is I think they're valued fairly well. I think forward PE is just under 15. They got plenty of room in their payout ratio. I think the free cash flow is historically around 40 to 50%. So kind of like the tech stock in the tech area, they kind of dominate in all they do. In my line of work, for example, as an automation engineer, we cross over into the IT work quite a bit, and everything is Cisco switches, Cisco systems. They're literally everywhere. So there's plenty of room for growth. I like the dividend, as I said, the dividend growth. The earnings growth is about 5.34%. So that's my pick for the week.
Nice one. And I always hear very good stories about their management culture as well, at least on the top about CEO and such. Um, I've been looking into Cisco several times, and it's really nice that you mentioned that because I thought like, who still wants switches? But now I hear like I'm totally not familiar with your line of business. But if you tell me it's a top-notch product, it's really good to know because for me it sounded a little bit outdated the last time when I looked at it. So that's really cool to hear.
They're probably more relevant in my line of work now than they were 10 years ago. So
Yeah,
they are, but for us, they're the go-to company.
yeah,
Any vendor that I've worked with over the last 10 years, it's always Cisco. Rockwell switches, for example, are built off Cisco. So they're pretty much behind everything in that area. So
mhm.
I really like them as a company. As you said, you mentioned the management. I feel they're really good. Plenty of room to grow their dividends. So that's why I've chosen them this week.
Cool. So I think we're coming to the end of the show again, EMF. It went quick this time.
Very quick as always.
Yeah. I hope that the readers also enjoyed to hear a little bit about our Q2 performance. It's probably not always that easy to give all the numbers, but let us know what you thought about it. We found it also really nice to answer the questions from the readers, so keep them coming. I will keep posting on Twitter, asking Twitter every Thursday or Friday whether someone has questions, because personally I love answering them, even if I don't feel the most competent person in the world to answer them. But that's probably also a good moment now to ask for people, if you are, for instance, really a growth investor and have a feeling you have a lot of knowledge to share, let us know. We would love to have someone on the show one time. The same applies to someone that really knows a good tax advisor. I would love to have someone on the show that really can explain from a legal point of view actually dividend tax across Europe, and more about the double taxation treaties. So yeah, if you know someone, let us know. We're more than happy to reach out to someone to ask them everything you want and we want.
Yeah, and for me, I just want to say thanks to everyone who's listened in the last couple of episodes and the support we've got in the comments, and we do really appreciate it. We love talking and chatting, and we love people's questions. As DJI said, it's not always our comfort zone, but it's what helps us learn and grow, and hopefully we'll pass that on to our listeners as well. So please free to subscribe and like to us, listen to our previous episodes. Let us know in the comments below what you thought, what you'd like us to speak about, and we'll get back to every single one of you. So thanks again for listening, and we'll see you all next week.